One of the most confusing parts of the real estate process are closing costs. Yes, you do have to bring in additional funds besides your down payment in order to purchase a home. However, what if I could tell you that you could save thousands by utilizing seller credits on your next property purchase? I'm Hannah Escher. I'm a mortgage advisor and rookie investor with 2 properties, and I'm so excited to talk with you about this topic today. First, what are closing costs? Well, closing costs are all the financial costs associated with purchasing a home or getting a loan. And I say or because even if you purchase a home in cash, you are still going to have closing costs. The reason being, anytime you transfer property from one owner to another, there are costs associated with that transfer. Now, if you're getting a loan on the property, those costs are usually higher, because there are more items that are going to be required in order to secure that loan. You're going to have loan costs, you'll have title costs, there'll be taxes, insurance, and then if you're setting up an impound account, there's also going to be a lump sum that you are paying forward for yourself in order to pay your property taxes and insurance down the road. And as a brief overview, an impound account is an account that's set up for you at closing if you have less than 20% down, or is optional to set up if you have more than 20% down. And what it does is allows you to pay your property taxes and insurance on a monthly basis with your mortgage payment. So when those come due during the year, your loan servicer is actually going to pay those on your behalf with the funds you've been giving them each month. That is a significant cost at closing if you're setting up an impound account. Usually that's going to run anywhere from $2,000 to $3,000 to even $10,000 depending on what your property taxes look like. If you're purchasing a very expensive property, it could be much higher than that. So those are the different brackets that you're going to see in your closing costs. These can look different also for different states. So keep that in mind. Just because you see an example of a closing cost breakdown on the internet somewhere doesn't mean that's what you're going to see in your state in your purchase. So that's why it's always very important to work with a professional, a mortgage advisor, to make sure you understand what all these costs are going to be specific to your situation. Now, how much do these closing costs usually run? Well, most of the time, it's going to cost you between 2 to 3% of your purchase price. The less expensive your property is, the higher your closing costs are in relation to that price point. So for example, if your property that you're purchasing is around $500,000, you're usually going to be paying around that 3% mark for closing costs. So around $15,000 is actually a really good estimate. And in my experience over the past couple years, especially, closing costs have increased because title fees have also increased with inflation, which then increases your closing costs overall. Now for seller credits, the whole reason we're here. Seller credits are a way that a seller can help offset your closing costs. And I want to be very clear about something. Sellers can use a credit to help pay for your closing costs. However, they cannot use credits to help pay for your down payment. That is a very large differentiation. There are limited capacities in how those funds can be used. And in most loan products, you as the buyer are going to have to come in with your down payment. The only exception to this is if you're getting gifts, or if you have a family member that you are purchasing a property from, they can give you a gift of equity. And then if you're purchasing a property from another seller that you don't have any relation to, your family can also give you a gift towards that down payment. However, the down payment has to come from you or has to come from a gift that is being given to you. Now, there are some types of loans that the seller can do that, but that's not going to be with loans backed by Fannie Mae and Freddie Mac or the government. So if you're looking for the seller to contribute to your down payment besides your closing costs, that's where you're going to want to look into seller financing. And that is going to require a whole other video. So back to seller credits and how they help you with closing costs. So let's say that you are purchasing a home for $500,000 and your closing costs are going to be $15,000. You can actually ask the seller to cover that $15,000 for you. There are limits on what the seller can contribute to your closing costs, and that all depends on how large of a down payment you're putting down and also the loan type. So let's get into that. So if you're purchasing a home with an FHA loan, a seller can contribute up to 6% towards your closing costs. So if you're purchasing a home for $500,000, the seller could actually contribute up to $30,000 towards your closing costs. That is a lot of money. If you were able to get a seller credit in that amount with that purchase price, then maybe you're also going to buy down your rate, right? Because the seller is going to be able to contribute over and above what those closing costs would be. If you're in that situation, look at ways that you can reduce your monthly payment or utilize that seller credit to help you have a more affordable loan and a more affordable payment. If you're going conventional, this is where the seller credit does depend on how much of a down payment you are putting down. If you're putting down less than 10% on the property, then the seller can only contribute up to 3% towards your closing costs. And that's really important to make note of, because there are going to be situations where maybe there's a property that you love, but you're going to need a rate buy down and you're going to need to cover all your closing costs, but you only have 5% to put down. In that scenario, the seller can only contribute up to 3% towards your closing costs. So that's where maybe we need to look at a different property, right? So something really good to keep in mind if you have limited funds. Now, if you're putting down anywhere between 10 and 25% using a conventional loan, the seller can contribute up to 6% towards your closing costs. That gives you much more flexibility in how you can utilize that credit besides just paying for the closing costs. That's where the seller might be able to help pay for a buy down to help make your loan more affordable. If you're putting down a down payment of 25% or more, then the seller can actually contribute up to 9% towards a seller credit. That is a lot of money to be contributing towards a sale. So if that's the case you're in, then most of the time in that situation, there's going to be some things going on with the property that you're really going to need the seller to kick in that contribution for. In my experience, there's not many times where the seller is going to need to contribute that much in order to make a sale fair for both parties. So each situation is different though. And remember, your situation is unique to you and your property that you're purchasing is going to be unique to your situation. So it's great to know this information in case something like this comes up. Maybe you are putting down a very large down payment, but the property needs a lot of work and you want to really buy that rate down, then get that seller to contribute up to 9%. Pay for all your closing costs, pay for all that rate buy down, and then possibly contribute to some repairs on the property. Now, if you're looking at a VA loan, your seller contribution limit is going to be 4%. And VA loans do have specific things that sellers can contribute to as well. So make sure you speak to your loan officer about that and make sure you know any state-specific costs that are going to be incurred for you. Now, if you're looking at a USDA loan, the seller contribution limit is 6%. So again, it's a little bit more generous, just like that FHA loan. And with a USDA loan, you can actually go into that purchase with zero down. However, USDA loans do have a lot of regulations around them. So not everyone qualifies for those, and also not every property is going to qualify. If you're interested in a loan like that, again, speak to your mortgage advisor, and I'm sure we'll do a video at some point. Now, let's go over the pros and cons of seller credits. The biggest pro is that it really can save you thousands of dollars. It can help you get into a home purchase with a much lower cash investment. That is going to be the biggest pro. The con is going to be that sometimes it can make your offer look less competitive. However, there are many ways around this, and there are absolutely ways to create a winning offer with seller credits, and we'll go over that in a minute. But let's talk more about this. Why does it make your offer look less competitive? Well, many times for sellers, they're looking for offers that seem to have the lowest amount of risk. And anytime time that you're asking for the seller to help you out, that can look like a risk for the seller. This is why it's so important that your mortgage advisor call the listing agent when you put an offer in. You want your mortgage advisor to talk about your pre-approval, talk about your situation with that realtor so that they can communicate that to the seller. I've worked on so many deals with seller credits, and it's absolutely not true that all of those deals that had seller credits are because the buyers needed to save on cash. That is not always the case. A seller credit is a negotiating tool to help both parties get what they need in a transaction. It's very important that you have your real estate professionals advocating for you and making sure that the seller and listing agent know your actual situation. Sometimes a seller credit is going to be used to offset your cash investment. And if that's the case, then you want to go in with a very competitive offer. So how do you make an offer more competitive when you're using seller credits? One way is to build those closing costs into your loan so the seller is really making the same amount of money they would at the end of the day. Let's break that down. So if you're looking to purchase a home at $500,000 and your closing costs are going to be $15,000 and you want to save that $15,000 in cash, you don't want to have to put that out for closing costs. A way to make your offer more competitive while asking for that seller credit would be to add that $15,000 onto the purchase price. So instead of offering $500,000, you're going to offer $515,000 and ask for that $15,000 seller credit. That is going to put the seller in a position where they're going to make the same amount of money regardless of if they gave you the credit or not. That is a great way to make an offer competitive while using seller credits. If you want to be even more competitive, bump that offer price up even more. Go up to $520,000 and ask for that $15,000 credit back. That's going to show the seller that you really want that property, that you're a serious buyer, and you're just trying to be in the best situation for yourself while giving them what they need. Another way to make offers more competitive when you're using these seller credits is going to be making your terms competitive. What does that mean? When you're placing an offer, you usually have contingencies. Some of these contingencies are going to be inspection contingencies, appraisal contingencies, and loan contingencies. Anytime you can make those contingency timelines shorter, that's going to be a more competitive offer for that seller. The reason being, once those contingencies are lifted, the seller has a much higher likelihood of keeping your earnest money deposit if you walk away from the property. Also, as long as you're lifting those contingencies, you are also more likely to move forward with the sale of that property. And all of that is going to make a seller more confident. Now, one of the things you can do to really make an offer with seller credits more competitive is lifting the inspection contingency. Not the appraisal and loan contingency, but the inspection contingency. This is the contingency that allows you to walk away from that purchase for any reason. If you are making an offer without that contingency in place, it does put more risk on you because you can't walk away from the property no matter. You can only walk away if there's a problem with the appraisal or the loan. However, if you know this property is in great condition and there's already inspections on it that the seller did and you want to be really competitive, that is a great contingency to lift if you're comfortable with it. That's something you can talk with your realtor more about and they can explain all the pros and cons to you. That's really going to be their area of expertise as they're the ones who are going to help you get that home inspection, pest inspection, roof inspection, well inspection. They can advise you on if they think that would be something wise to do per the property's conditions. Another important aspect to think about when you're talking about using seller credits for your next purchase is where is the market? Is it a buyer's market? Is it a seller's market? And how likely is a seller going to be to accept your offer if you are asking for a seller credit? Well, right now it really is is a seller's market. However, there's still so many opportunities for buyers. So in this market, sellers usually are going to have their pick of what offer they want to take. And in my experience, in my area, there's multiple offers on homes. It's very rare right now and over the past couple years that we're looking at just one offer on a home, even if that home has been sitting on the market. So in our area, it really is a seller's market, and they're going to be able to pick what offer matches their situation the best. If you're in an area that is more of a seller's market right now, it's even more important to make sure that you're crafting a competitive offer. Again, talk with your realtor and talk with your mortgage advisor about how you can do this. If you're hoping to save money on closing costs, have this conversation way in advance of putting an offer on a home. I know my team and I, we will actually pre-approve people with seller credits in mind. So if there's limited cash available and they need a seller credit in order to purchase that home, we're actually going to pre-approve them with that solution in place. That means we're talking with the realtor right away. We're talking with you as the buyer right away to make sure we're all on the same page that this is what we're going to do, regardless of what property we're looking at. That does mean that your offer may not be the most competitive in some situations. However, in my experience, I do feel like what happens is the house that's meant to be always works out. So if it's meant to be, you're going to find that right seller who's willing to take that seller credit. It's going to be the right property, and you're going to be in a good situation for yourself. I hope you enjoyed this brief overview of seller credits today, and that is going to help you think strategically about how you can save money on your next property purchase. I'm Hannah Escher. You can search my name on BiggerPockets, and if you found this video helpful, like and subscribe to the BiggerPockets Rookie channel for more videos just like this. I'll see you next time.